Real Estate Investing Unmasked. Today I want to talk to you a little bit about a comment that somebody had made on a previous video about how to pay off a mortgage in 5 to 7 years. I'll put a little link up here for you. The question was, can you explain how a mortgage is paid down, how the interest can change while you're going through the mortgage? So I thought it best that I use something to write on and show you. Because really just showing you an image on the screen on an Excel spreadsheet isn't always the best. So let me go ahead and put it to you this way. When you get a loan from a bank, let's say it's 6% interest, well, the bank has two options when you get the loan. They have the option to charge you interest on a monthly basis or to charge you interest on a daily basis. Now if you were to choose between one of the two, which one would you choose? And of course I can't hear you, so I'll choose it for you. The best one would be to be compounded monthly, to have the bank compound how much interest you owe monthly. And the reason that is you can pay down your mortgage more and more before they compound that interest, before they decide how much it is. Whereas if you do it daily, it's every day you get hit. If you finally put a payment down, that's fine, but then you get hit for those first 15 days. Let's say you paid it 15th and the 1st of every month. Those 14, 15 days in between each payment, those are 14, 15 days of interest that is accruing each time. But if you paid it on the 1st and the 15th and they did it every month, then in all actuality, you would have all that time that would not be charged interest. So it's a good thing to have it monthly. So this is how they do it. If you get a loan for, and I'm just going to use this because these are easy numbers, $100,000 at 6% interest, every month, if you get charged monthly, that's going to be 6% divided by 12, which is equal to 1/2 of a percent. Well, 1/2 of a percent of $100,000 is $500 per month. And hopefully you can read my handwriting. I can, so you know that works. So $500 a month is just for interest alone. If it were compounded daily, it'd be much smaller, a much smaller number. It'd be the 6% divided by 360 for a financial year. They don't typically do 365, but some may. It just depends on how you have the contract written up. So $500 a month in interest as long as you owe $100,000. So for the person who asked me the question in the comments, what happens is on that first payment, when you make the payment, you're going to pay the $500 for that first month, but you're going to pay some principal on top of that, because the idea is on the loan that not only are you making interest payments, you're also making principal payments. That is a fully amortized loan or a loan that is amortized to any level. There's going to be some principal payments. The principal is this, the amount that you borrowed. The interest is the amount that the bank makes for lending you the money. For the benefit of you getting that money, they need something in return. That is the interest that you pay. So $500 a month. If you make a payment of $550, what happens is this $50 right here goes toward this loan amount. That $100,000 now becomes $99,500, or sorry, $950. $99,950. So now when they charge the 0.5% interest the following month, it's multiplied by that, which means now instead of $500 for that interest, it's going to be closer to $499 and some odd cents or so. I don't know the exact number because I'm not doing it. Sorry, I'm not doing the math. But that's essentially, you're saving a couple of cents is what it turns out. And every month that you do that, this goes down a little bit more every month. And eventually, at the end of your loan, somewhere around year 10 or 11, 12, something like that, you go, instead of paying $50 towards your principal, you go more like $275 towards your principal and $275 towards your interest, if you just make the standard payments. So the idea is to make more principal payments, put more payments toward the principal as you go along to help pay down that principal amount, so that when they do the math to say how much interest they're going to charge you for that month, it's actually a lower amount. You're still going to be making the same payment, that $550. That remains the same. Okay? The only reason why that would change is if you don't have a fixed interest rate, if you have an adjustable mortgage and the bank has to adjust that payment. The other reason why your payment would go up is if you have your accounts set up as a principal, interest, taxes, and insurance. PI, TI. So if you have a fixed mortgage payment, say $550 a month, the other thing I didn't add into this whole equation is taxes and insurance. If you do have that in your loan, let's say that payment would be closer to, say, $700. That payment should remain the same throughout your loan, except for this, and that is that your taxes are likely to go up. Let's be honest, we can count on taxes going up. So if taxes go up the next year, it could be $710, or it could be $730, or it could be $750. It really doesn't matter. But that additional 10, 20 here or so, that's taxes that are being increased on your property because your property is supposedly going up in value. And typically, values in real estate in the United States anyway usually go up about 6% per year on average over the long haul. So it's a pretty good investment. Okay, so hopefully you understand about how interest is applied toward your principal, toward your mortgage, and how when you pay additional money onto that principal, it actually knocks down how much of your payment is going toward the bank and how much is going toward your own pocket via principal. So just as Billy had a question about how this all works, if you have any questions regarding real estate investment, please just leave a comment down below. If you subscribe to me, you'll get the videos that I make for you. And I don't mind making a video for you because there's more than you that has that same question. Thanks again, folks. See you next time.